Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to review how you might be using a HELOC wrong in terms of velocity banking. And if you have no idea what velocity banking is, all it is a debt payoff strategy using lines of credit like a HELOC as a main tool, right? So let's just do this. Let's quickly review how the average American uses a HELOC versus how you would do it with velocity banking. So we have a budget here. So the average American budget, where we have about $4,500 of income. We're going to assume we're a homeowner, right? And we have 3 credit cards and we have access to a $30,000 home equity line of credit. And if you don't know what a home equity line of credit, think of it as like a credit card based on the value of your home. But unlike a credit card, you can use it to pay anything and everything, right? So let's say we have $30,000 tied to a home equity line of credit. And this is what I've seen many times, folks. Well, not many times, a good number of times where someone sends me their financial data. They have, let's say, a $50,000 home equity line of credit, and then they have a $49,000 balance, right? And I'm going to show you in terms of velocity banking what the right way to use a home equity line of credit is versus the wrong way, right? And so here's the thing. When banks advertise home equity lines of credit to the average consumer, it's all about making big purchases, like maybe a kitchen remodel or something like that. And their hope is once you spend that money, you're going to just make minimum payments, right? And sometimes it could just be interest only payments. So I remember my dad was like, I'm against home equity lines of credit because every time I make a payment, the balance doesn't go down and I have no idea what happens. Like, duh, that's interest only, but he doesn't know what he doesn't know, right? And so if we look at this right here, this is our average American budget, income, expenses. Ooh, we only got $275 of savings left over, 3 credit cards, a home equity line of credit, and a mortgage, right? So what is the difference between this column, the average American, versus this column, which is velocity banking? It's certainly not the amount of income that we make because we assume the same income. However, there is one little difference, which is this goes to zero, right? The savings goes to zero, okay? And this is going to freak a lot of Americans out because we as Americans have been socialized to believe we need about 3 to 6 months to savings. And in certain contexts, it is true, but when we're doing velocity banking with the right tools, that is not true, okay? So let's go ahead and copy some of these numbers, right? And re-engineer expenses, okay? So the main difference, I'm going to tell you the main difference between this side and this side when it comes to the HELOC, right, is what's our main operating account. Now, for the average American, the main operating account is the checking account. Okay, we're going to pay things out of our checking account, and whatever's left over, we just put in our itty bitty savings. With the velocity banker, right, with this column, the main difference is that our home equity or our line of credit is our main operating account. And guess what happens to our payment when we make it our main operating account? Let's go ahead and finish this, right? So let's assume we have this is actually a $32,000 limit with a $30,000 balance, okay? So what happens when we make this into a main operating account? So let's actually review the velocity banking strategy. It's we put our entire paycheck into that line of credit, and what happens when we put that entire paycheck into a line of credit? Well, two things. Number one is that the minimum monthly payment is satisfied. And because the minimum monthly payment is satisfied, it essentially doesn't matter. Guess what happens? Oh my goodness, this turns to zero, right? This turns to zero when we make this into our main operating account. Isn't that amazing? That's why, whenever I see people say, oh, I need a HELOC, not necessarily true, but you got to make your HELOC into our main operating account, or else we're going to end up like this gentleman, where it's just like another debt like a credit card if we're not using it as our main operating account. Okay? So again, paycheck into line of credit, expenses out. And then our balance of our line of credit is going to go down by our cash flow. So let's go ahead and calculate our cash flow, which is C2 minus C3. Okay? So basically, we went from $275 to $825 in one swoop. And I know that 825 isn't really that great, but the point that I want to make is by making our home equity line of credit as our main operating account, we automatically increase our cash flow because this payment doesn't matter anymore because we're putting our entire, paycheck into that line of credit, expenses out. Now let's see how long it takes us to pay this off. So let's do I2 plus 1. And then to get the next month's balance, it's the previous month's balance minus plus the previous month's interest minus our cash flow. Now this isn't that much cash flow, and I figured that it's going to take some time to actually pay off compared to when we do the other scenarios. But let's just go ahead and write this down. So basically, to get the interest, it's the average daily balance. So we get the average this times 0.1, 10% divided by 12, right? And let's see how long it takes us to pay off, right? And here's the thing too. What we can do is we can actually move these cards accordingly. So right now we see that we could probably put $6,000, here's the thing, after about 8 months, right? After about 8 months, the balances of these are actually going to go down, right? And the payments are actually going to go down too because credit card payments are proportional to the balance, right? So this isn't going to be a fixed payment, but let's just assume, just to make the demonstration easier, that this is still $6,000, which is not possible. But again, this is why we're doing fuzzy math. So let's do plus $6,000, right? And guess what happens when we transfer the $6,000 of credit card debt? Oh my goodness, a 210 cash flow increases, right? That's the beauty of transferring our debt into our main operating account, is that we're just essentially going to maximize this cash flow number, right? So let's go ahead and keep going. And let's do this. Let's see. Okay, so now what we got to do is subtract our new cash flow number, which is 1035.83. Okay. And then now we just keep going. And I guess we could just move this one. So how much is our limit? It's 32. And it's not going to be 7K at this point, but just play with me. Or is that the right phrase? I don't even know. Play along with me. Don't play with me. All right. So now, again, I might actually do this a little different in real life, where I'm just like always maxing out that HELOC and transferring as much credit card debt as possible. But we're breaking this up into little chunks just to make the demonstration a little bit easier. But now let's just move this, I don't know, 7K into that line of credit. So 24 grand. If I add 7, is it below 32? Let's just try it right now. Plus 7000. So now it's 31. So yes, just as long as it's below this $32,000 limit, we should be fine. And guess what? Oh my goodness. This goes to 0. So now our cash flow is now 1275. So it's like, and after how many months? After about 16 months. So we were in this itty bitty cash flow, but now we're in $1,200 of cash flow. Not bad, right? So I know I've done a lot more better situations in other videos, but sometimes you don't have the most ideal situation, especially if you're making only $275 left over in savings, right? All right, so now we just do the same thing over and over again. So we just have to fit in, it wouldn't be 10K, it's probably going to be 8 or 9K, I don't even know. But let's just assume that we do 10K, and we're going to do this. Okay. So now we've added the $7,000 here, and then what's our new cash flow? 1275, right? 1275 plus 1275. Oopsie, minus 1275. It's really late here. Okay. So now we just keep going, right? And then we're going to, once we have enough room available in our line of credit, and again, I know it's not going to be 10K at this point, right? But just bear with me here. So we move this 10K into the line of credit, and so we'll just move this 10K right here at this point, just as long as below 32. So plus 10, 0, 0, 0, 0. Oh my goodness. Okay, so we transfer this. And then at this point, guess what? Because we moved this credit card balance, this goes to 0. And now we went from 275 to 1600. Okay, so let's go ahead here. And so now this is minus 1600. Okay. And we can see that now it gets paid off in about month 48. What's 48 divided by 12? About 4 years, right? 4 years. We're going to pay off these 4 things, the HELOC and these 3 credit cards. Now, what is the difference between this column, where even though you have a HELOC, it's not velocity banking, versus this column, it's that you make your line of credit as your main operating account, and whenever you do that, guess what? This payment doesn't matter. It goes to 0, right? That's how you increase your cash flow. Okay, well, just another quick velocity banking review before I go to sleep. Oh my goodness, it's getting pretty late. Oh, I'm going to sleep and I'm getting sleepy. Well, all right, everybody, have a great night, and we'll speak next time.